Hello, welcome to Module 2 of Finance 600, the fundamentals of corporate finance. I'm doing this module by video because we lose an entire week of class due to the Martin Luther King holiday. Obviously our class is on Monday night, the night of the holiday, and if we had a class on Wednesday night, we'd have an extra week. So to make up for that, I'm creating a video. Hopefully you can watch this video at your leisure. It is not meant that you would be watching it on the holiday itself. I don't mean in any way to diminish the holiday. I'm a big fan of Martin Luther King, but I hate to lose a week of class. This module deals with working with financial statements. And although our class is in finance and not in accounting, there are certain accounting-like or accounting principles that we need to understand and to use as a foundation for our financial calculations. That's what this module is intended to do. I apologize in advance. If you're an experienced financial expert, you're going to think, first of all, that this is very simplistic. And for that, I apologize. The other thing is, if you are a financial expert, you're going to realize that some of the ratios and some of the calculations that we use are simplified for the sake of the class. And this is because many people in the class are very new to finance. And we're trying to teach the fundamentals and fundamental principles and not getting into the accounting details. So let's kick off and take a look at our slides and move into the presentation. So we're going to learn a number of key concepts and skills, learn how to interpret financial statements, learn how to evaluate financial performance, which is a key financial function for all financial executives. And we'll learn how to plan future financial performance. In the module, we start with understanding why businesses need cash and how we can calculate it. We look at sources and uses, and we look at the cash cycle. Then we move on to ratio analysis. And again, I apologize in advance. This might seem a bit of a numbers tumble, but these are the key ratios that are used by financial analysts, both inside and outside firms. And so I want to do a level set that we're all using the same vocabulary and we're all using the same calculations. Then we're going to look at something called the sustainable growth rate and the internal growth rate and the DuPont identity, which again help us to evaluate financial performance, but more importantly help us to understand how companies can fund their growth. We'll move on then to learning how to prepare pro forma financial statements and forecasts. We do a bit of forecasting in this class. And again, I want to give you some basic background as we move into more detail later in the class. Finally, we're going to look at how we calculate the need for external financing, which is a handy calculation for all financial executives. And then we'll have final thoughts. So starting off, let's just do a little bit of conceptual analysis. Which is what happens to the balance sheet when sales increase, assuming all sales are on credit. And we're going to look at some information. Later on, we'll do some mathematics. But basically, because all sales are on credit, and by the way, that's a fundamental assumption that we make in this class, a simplifying assumption. That all sales are on credit, so avoid some complexity of dividing sales between cash and credit. When all sales are on credit and sales increase, accounts receivable are added to the balance sheet. Maybe precisely we could say accounts receivable minus accounts payable, but there is always a gap between the two. So total assets increase as sales increase. And as we'll see as we go through the module, as total assets increase, we have to think about how that increase is funded. If you think about it from an accounting standpoint, the left-hand side of the balance sheet is increasing. Something has to happen on the right-hand side of the balance sheet. The second thing we want to think about is what happens to the balance sheet when a firm earns positive net income and ignoring dividends. And finally, what happens when assets are purchased? Obviously, as assets are purchased, the left-hand side of the balance sheet increases. Somehow, the purchase of assets has to be funded. That's on the right-hand side of the balance sheet, and obviously the balance sheet has to balance. So we have to think about what happens on the right-hand side to balance the balance sheet. Credit is critical to any economy. Credit is actually an ancient concept. It's over 4,000 years old, meaning that 2,000 years before the Christian era, companies were lending money to other companies, or people were lending money to other companies for the companies to finance their growth. And they were paying interest. And so you can see it's gone on for a very long time. How do companies finance their business? Well, there are a number of tools, and we'll cover most of these during the course. For very large companies, commercial paper is used. Commercial paper is essentially short-term IOUs issued by companies. They are issued in a public market or a quasi-public market, depending on the size of the company. But it's only available to the very largest companies. It is probably the cheapest form of financing. The second and the most common form of financing is financing by commercial banks. All private companies finance through commercial banks, at least all private companies that need financing, and many public companies as well. Third category is public debt, and we'll spend quite a bit of our time in this course thinking about public debt, doing the mathematical calculations for public debt, and understanding more about how the public debt markets function. But one thing about the public debt markets is they're only available, obviously, maybe it's not obvious, but they're only available to public companies. That is, companies that are registered under the 34 Act. And even then, only to the largest public companies. And when we get into the module on bonds, we'll discuss public debt at greater length. Finally, the last two, companies finance their growth through profits. Profits minus dividends, which are retained earnings. And then if nothing else is available, then they finance their growth through the sale of equity. But equity is very much a last resort for most companies. First of all, it's an expensive form of financing. We'll do the mathematical calculations later in the class to show you this. But second of all, it also dilutes the current shareholders. And generally, shareholders are not happy to be diluted. Frequently, it's the case that companies go public, and once public, will never again issue any equity. To give you an example, Apple went public in the 1980s and has not issued, early 1980s, and has not issued equity since that time. Business models dictate the need for cash. Some firms have a business model where they get paid in cash or cash equivalents up front, meaning before they supply the service. A good example is Amazon. If you go onto the famous website, Amazon.com, and attempt to buy anything, you have to put in your credit card, and essentially Amazon gets paid immediately. So that changes their need for cash. Most firms, however, get paid after delivering a product or service, and they get paid not in cash, but with a promise to be paid later. This is called an accounts receivable. And if you've had finance in the first semester, you're very familiar with this. If you're joining us in the second semester, you may not be so familiar with it. But that's the term for this is called an accounts receivable. Boeing Airlines is one of my favorite examples because imagine the situation with Boeing. They sell a plane for tens of millions of dollars to an airline, and it turns out that Singapore Airlines, or Sing Air, is Boeing's biggest customer. I've forgotten the size of the contract that Boeing has with Sing Air, but it's for monumental amount of money, and might be $1 billion contract over the next 5 or 10 years. But when Boeing delivers a plane, they don't get paid for 6 to 9 months by Singapore Airlines. So Boeing is recording that transaction as a sale when they deliver the plane. And under accounting terms, that becomes a completed transaction. They take the profit inherent in that transaction into their income, but they don't have cash. Instead, they have an account receivable. And that, in the meantime, not only has Boeing built the plane, but now they have to wait to get paid. And when Boeing was building the plane, they were paying wages, they were buying parts, they were contracting with subcontractors. But all of that was financed by Boeing. And finally, they deliver the plane, and they still don't get paid for another 90 days or even 6 months. And during that time, they have to continue to finance and continue to carry the borrowings that they entered into to build the plane. So that dictates a different need of cash than Amazon. And then there are some interesting exceptions. Another one that I love is Geico. Why is that an exception? Because when we buy insurance, how do we pay for it? We pay up front. And when I buy insurance on my car for the year 2019, I had to pay for it in 2018. So not only do I pay for it in advance, I even pay for it before the year has started. And if a Geico has a payout, when do they have it? Well, much later in the year. So Geico has money up front, and they don't pay until later, which is a great business model, which is why Warren Buffett owns the company. Now, you could think about it a little deeper, and you would say, well, on average, some client of Geico, some customer, has a claim every single day of the year. And assuming that they're spread throughout the year because they have a large base of customers, their average claim then is about July 1st, the middle of the year. So Geico gets 6 months of free money from us, their customers. And that dictates a completely different need for cash than Boeing, who doesn't get paid until long after. So each of the businesses listed on the previous slide had a different financing need based on their business model. And that dictates their choice of financing. Later in the course, we'll look at choices about financing and how they get financed, and we'll spend a little time thinking about companies like Amazon and Geico as we go through this module as well. I want to turn now to a second topic, which is understanding something called common size financial statements or common size methodology. And the idea here is that when we look at a financial statement, and when we look at the balance sheet in particular, we can calculate all accounts not in dollar terms, but in percentage terms, as a percent of total assets. And when we look at the income statement, we do the same thing. We change all the dollar terms into percentage terms, this time as a percent of sales. This is a very useful method of comparing companies of different sizes, particularly within the same industry. It's also a useful method of comparing the company at one point in time to the same company at another point in time to compare financial efficiency on various ratios. So it's something that's very common. Another common use of it is in building a financial forecast. So I'm displaying on the screen a simple financial forecast, and let's see if I can display the entire financial statement for you to look at. I don't think I can in this format, but what happens is the assumptions are on the top part of the financial statement, and then the financial statement, and some of those assumptions have to do with sales growth and EBIT to sales. Oh, they're here. And so we can look at these, and we can see the assumptions that are built into our model, and then we can use these assumptions to calculate specific items in the financial statement. As we calculate the other line items, again, we use percentages, the EBIT percentage to sales, to calculate EBIT, and we follow that through with the rest of the pro forma financial statement, including things like net working capital and changes in net PP&E. We're using a basic assumption, even though I've stated this as 1.98 rather than the percentage. We're using this to calculate the numbers as we move through the financial statements. So this is a very handy way to do a basic financial forecast. In the real world, many times, and maybe there are people in the class that are financial experts and they have a better way to do it than I did, but when I was working as in the finance department of my company, we usually started off with something very basic, just like this. We would start off assuming that the working capital was a fixed percentage of sales, that PP&E basically was always the same percentage of sales, and so forth. And we did that just to build out the first simple model. Then, of course, we'd start playing around and asking ourselves, well, what if this happens? What if that happens? What if it goes up? What if it goes down? What are the impacts? We would do that to refine the model. But building the first basic model, we would just use the same percentages for each of these line items that the company had most recently. Sometimes we would use the most recent fiscal year. Sometimes we would look at the preceding 5 years, do an average. There are a number of ways to do the percentages, but many times sophistication in doing it doesn't necessarily get you a better answer. So sometimes the simplest way is just fine. Just take the last year, assume the trends are about the same unless you know some reason to change them, and roll it forward. We're going to play around with this as we go through the class. So this is very much an introduction of a topic. Don't be alarmed if you look at this, and please don't panic. To look at this and say, oh my God, how am I going to do this next week? We'll have quite a bit of time to play with this and to use some simplified examples to begin with, and then we'll make them increasingly complex. So the second big thing I'm going to talk about today is ratio analysis. And again, I apologize in advance if this seems like a bit of a dry numbers tumble. It probably is. And it's difficult to really make this more lively than it sounds. And before I go on, let me also mention that the numbers that we're going through here are pretty much standard ratios that are used by lenders and shareholders, analysts, and the analyst community in analyzing financial performance. They're used by rating agencies in analyzing financial performance. I've posted on Canvas the Harvard Business School sheet of ratios that are used in their classes that are the equivalent to our class, the Introduction to Corporate Finance. And really to give you some reassurance that I'm not insane, and this is what we teach and we have to teach, because again we need a kind of a level set. If you're an experienced financial executive or accountant, you'll recognize that some of this analysis is simplified. And the reason is that in this class we're really teaching fundamentals. And we're teaching fundamentals to a lot of people who have never thought about finance, or if they thought about it ever, they thought about it 5 or 10 years ago. So we make some simplifying assumptions. You could argue with me about how to calculate various things, but as you'll see, these are things, again, that we try to do to focus on the fundamentals and not really in a lot of the technicalities. Why do we use ratios? Well, first of all, they're used for comparison through time. For our own company, they're also used to compare companies. Now, a lot of times people get very caught up with ratios, and it's important to think about some of the limitations. When we look at the ratio, about how it's computed, what it's trying to measure, certainly be careful about the units of measurement. What does it indicate? And how can we improve the ratio? A lot of times financial executives get very excited about, and I fall in this category, so I say it lovingly, we get very excited about trying to improve the financial ratios, and some of it, occasionally comes down to changing the way the company does business, and that usually isn't a winner. So, on the other hand, if there's a way to nudge the company or to shift, the way the company does business, that can be beneficial for everybody. I'll make some comments about that as we go along and just tell you what my experience has been. Again, and there are probably students in the class who have as much or more experience than I do. Well, probably can't have more because they're younger, but they have very relevant experience. So we look at ratios, and there are 5 categories: solvency or liquidity, leverage, efficiency, profitability, and market value. Now, this list probably has no meaning. Let's go through them one at a time, and we'll give them a little more meaning. So, liquidity. The famous, the sort of fundamental building block of liquidity is the current ratio, current assets over current liabilities. In our class, to calculate current assets, we simply take it right off the balance sheet, the line that says current assets, and we pick up the line that says current liabilities. In most cases in our class, you don't have to make any adjustments. You don't have to worry about what's in current assets or what lines are in current liabilities. We just keep it simple and use the ones that are stated in the financial statement. If for some reason you're given individual lines, the current assets that we have in this class are simply cash, accounts receivable, and inventory, and the only current liability is accounts payable. So if for some reason you were not given the totals, that's how you would calculate the totals. The quick ratio is shown on your screen. We don't use it so much in our class, but it's a very standard ratio. You'll see it on the Harvard sheet. So you should be aware of it. We don't tend to use it very much. We do use the current ratio quite a bit. So measuring leverage. When we say leverage in this class, it means debt, the amount of debt, and the word leverage implies the relationship of debt to equity. If a company has no debt, then they have no leverage. They're an all-equity finance company, but most companies have some debt. Of course, famous examples that do not have debt are Google and Facebook, which we will examine much later in the class. First of all, we think about debt in our class. We think about debt and equity on a market value basis. So in the accounting world, of course, debt and equity are calculated on a book basis. In our class, we calculate them on a market value basis. That's one of the fundamentals of finance and one of the fundamental differences between finance and accounting. So we use market values. Measuring the market value of equity is easy. You can go to Google or Yahoo and you can figure out the market cap of a company. It'll be listed. So that's not a problem at all. Measuring the market value of debt is harder. It's not transparent. If you have a Bloomberg machine, you can look up the market value of debt for any security. When we get to the section of the class about bonds, we will look at, we'll be able to look in real time at the market value of debt, and you'll see that debt which is frequently issued at par and frequently issued around $1,000 per bond, very seldom trades at par. But in this class, because it's hard to figure out the market value of debt, in many cases we'll use the book value of debt as a convenience. So in starting off in the class, we'll be using the book value. Later in the class, we'll be calculating market values of debt under various assumptions. Obviously, if you're looking at a problem on an exam, it will tell you, it will either give you the various assumptions you need to calculate the market value of debt, or otherwise you use book value. So how do we compute leverage ratios? In our class, we use something called the market capitalization ratio, or it can also be called the leverage ratio. And I tend to default to call it the market cap ratio. And the ratio is simply this: it's debt over debt plus equity. A simple example is assume debt is $997 and equity is $2591. What's the ratio? Well, the numerator is going to be $997, of course. That's debt. The denominator is going to be $2591 plus $997, or $3588, which would tell us that the leverage ratio is 27.8%. We frequently will abbreviate the denominator D plus E as V, and V is value or market value. It'd be helpful to remember that, because particularly when I'm writing on the board, I default frequently to D plus E. The other ratio that's commonly used is debt to equity. So in our case, if we were looking at debt to equity, we would be looking at the 997 to 2591. In finance, and that is occasionally used. It's used quite a bit in what I would call conversation. It's I don't think terribly helpful. But when you deal with lenders, rating agencies, shareholders, the market, the leverage ratio is the one that's more commonly used. I would say, hate to say invariably used, but it's by far the more commonly used. But when you pick up a newspaper and somebody's writing about it, they will frequently write about it as a debt to equity ratio. So be very careful and conscious that if the ratio on an exam question says debt to equity is X, that's generally not the ratio we're going to need for our calculations. We need to find the ratio of debt to D plus E. And how do we do that? Well, imagine a simple equation that said if debt to equity is 0.6, it means it's 0.6 over something that equals 0.6. So if we were solving for X without doing any complex math, what number will allow, make sure you can see this is a 0.6, what number will satisfy this equation? Well, the number 1. So equity in this equation equals 1. So now when we want to do debt plus equity, so we have 0.6, that's debt. Now we want to have debt plus equity on the bottom, on the denominator. We know debt is 0.6. We're told that. And we just found out that equity is 1. So that equals 1.6. So in this case, the way to calculate the leverage ratio is to make this modification, and we would find out that 0.6 over 1.6, I have to get out my calculator because I can't remember it anymore, and I don't want to be guilty of telling you the wrong number, is 37.5%. So that's the leverage ratio. So you've been given 0.6, and what you have to remember is it's always going to be the same format. It's always going to be 0.6 divided by 1 plus, whatever the numerator is, divided by the numerator plus 1. And if you remember this simple little example, you'll be able to make the calculation yourself. In our course, when we talk about debt, we're talking about interest-bearing liabilities or interest-bearing obligations, and those might be called loans from. So when we look at a balance sheet, we may see a variety of different things. They might be called loans from banks. They might be called notes payable. There will be a caption usually of current maturities of long-term debt. So you have to remember to include that because that's up in the current liability section. Then there'll be long-term debt frequently, but debt does not include accounts payable. And remember, it doesn't include accounts payable because in the normal course, they're not interest-bearing. So when we're trying to calculate debt, particularly for doing problems or exam problems, remember that debt refers to interest-paying obligations. So we have two leverage ratios that we use. The preferred one we have is up on the top, debt to debt on the numerator, in the numerator, to debt plus equity in the denominator. Sometimes we'll see a debt to equity ratio, and generally in our class we're going to need to convert it into the top one, into debt over value. And remember, debt plus equity equals value. So sometimes you'll see me write debt to value or equity to value. Equity to value. And value, remember, is just D plus E. So especially if I'm up at the board and I get impatient because I don't like having my back to you, then frequently I'll just abbreviate it with V. So remember, the V is D plus E. Remember down here, particularly if you're a financial executive and you're an expert, you're going to probably be upset with me because I'm not including leases. And certain leases are treated as debt. They're very much treated as debt by the rating agencies. But in our class, we ignore that. We don't get into that. It's more of a technicality that does not enhance the learning of fundamentals, so we just ignore it. But I want you to know I'm intentionally ignoring it. It's not unintentional. The other important ratio, so leverage ratios are extremely important. It really gives the outsider, an analyst or a shareholder or a lender, a viewpoint of the extent of debt. How much debt does this company have? How do we measure it? Because a number in and of itself doesn't mean anything. Think about Apple Computer. Apple Computer, last time I looked, Apple Inc., I should say, had about $7 billion of debt. $7 billion sounds like a lot, but actually it isn't. When you realize the company's worth today, on November 13th, the company's worth $920 million. A month ago it was worth $1 trillion, but we've had a bad month. Hopefully by the time you see this lecture, it'll be back up to over $1 trillion. So obviously, $7 billion to $1 trillion is trivial. And that's why the sheer amount of debt by itself really doesn't have very much meaning. What has meaning more is the relationship of debt to equity. The other important one is what are called coverage ratios. And in my vocabulary, I call it the interest coverage ratio. And you see it on the screen. It's EBIT divided by interest. If you assume EBIT is 691, I just picked this out of the air, and interest is 141, you just take 691 divided by 141 and you get a number which is 4.9 times. 4.9 times, again, doesn't mean anything in and of itself. What you really have to know is what are the basic benchmarks. And one basic benchmark is investment grade from the rating agencies. And usually people would say 2.5 times is the minimum investment grade, minimum coverage ratio for a company to be investment grade. AAA companies have coverage ratios that are 15 times or more. So that gives you a little bit of help in understanding what 4.9 means, but this is how we calculate it. So that's the math right there. The cash coverage ratio, which is a number that's used in the financial world, but we don't use it much in class, is this one right here, and here's the math for it. But to be honest, we don't use it very much in cash. I would focus on the times interest earned. To me, times interest earned is a little bit academic, but when I say interest coverage ratio, I mean this one. I mean EBIT divided by interest. next series of ratios are efficiency ratios, and we'll start with inventory. Inventory, payables, and accounts receivable are the major efficiency ratios. Almost all of them are going to measure two things, so they're going to look very similar. They're going to measure turnover, which is basically the concept is I have a warehouse, it's got some inventory, how many times do I replace it in a year? That's what we're trying to figure out. And that's called turnover. So if I turn it, it's the vocabulary, 2, 3 times, 4 times, 5 times a year, the higher the number, the better. It means I'm controlling my expense because inventory is an expense. And if I have a high turnover rate of 3, 4, 5, that's considered a good thing. So the first thing we calculate is the turnover rate. And in inventory, it's cost of goods sold divided by inventory. And in our class, we use ending inventory. We don't use average inventory. I know many of you that are accountants would object to using ending inventory, but again, we're trying to learn the fundamentals and not get too tied up in more complicated math. So in this case, the cost of goods sold, which is always abbreviated as COGS, equals 1344. I just made up this number, also made up inventory. I think I got these originally out of some book somewhere. And seemed like as good as anything. It's a simple division. It tells us that the inventory turned 3.2 times. Again, without more context, we don't know if that's good or bad. We would know by two things. One is comparing the company to itself. So maybe last year inventory turns were 4 times, so they've gone down, so that's bad. Maybe last year they were 2 times, going up to 3.2 would be good. Or we would look at competitors. Maybe there's a competitor that has an inventory turn of 4 times. That would say our company was not as efficient in managing their inventory. So companies look at their inventory turns quite carefully if they're in a business that has physical inventory. The other thing that we always calculate is days sales. And so the number of days sales that are in inventory, what that's saying is basically how many days does it take to turn the inventory. And it's 365 divided by the inventory turnover. So in this case, it's 114 days. It's pretty much that simple. But take a look at this, review it, because there's usually silly questions on exams that have things about this elementary. Why do I do that? Because I'm trying to put easy questions on the exam. But sometimes what I think is an easy question, students don't think it's an easy question. But that's why I warn you in advance, and you'll find during the course of this class, I'll warn you over and over, like this is something you're going to be asked for in an exam, because it's really just testing that you understand the basic fundamentals. We use the balance sheet balances in this class. What that means is balance sheet balances are showing you the balance of an account at the end of a year. So with one exception, we just pick the numbers right off the balance sheet. And we know those are ending numbers, not average numbers, but we use those because it's convenient. And again, we're trying to teach fundamentals and understanding of fundamental principles. Receivables turnover is calculated this way, sales divided by AR. So I call accounts receivable AR. Most of the time I call sales revenues. They're the exact same thing. So again, if you're not a financial maven, if my vocabulary seems confusing, please raise your hand and ask me. Because there are a number of things that are, sales and revenues for our purposes are equivalent. AR and accounts receivable are absolutely equivalent. So I lapse into one or the other, and I'm usually inconsistent, by the way. So, please raise your hand and ask me if you're not sure. So again, to calculate the turnover, we have the sales made up 2311 divided by AR, which tells us that AR turnover is 12.3 times. When we want to figure out the days in AR, we divide 365 by the 12.3, and we get 30 days. So that tells us that this company, 30 days in receivables would be actually very good. So the average in America, as I recall, in my era, was about 42 days. But it very much depends on the company and the industry and the context. It also depends, a lot of times we're looking at this on a balance sheet basis, where we're looking at international receivables as well, which frequently have different cultural standards. So if you had a 30-day collection period, would be unheard of in France. 90 days is normal. World class would be 60 days in France. So if you're looking at a mix of a number of different countries, you may well find that the mix, the specific percentages, drive the consolidated total. But what we do is just take it off the balance sheet. That's what we have. Total asset turnover is another key metric. Sales divided by total assets. Again, just an example that I made up. Sales are 2,311, and assets are 3,588. Simple division, we find out that it's 0.64 times. It's not unusual to have total asset turnover of less than 1, particularly for companies that have a large amount of fixed assets. And if we wanted to do the days of total assets, we'd do the exact same thing, 365 divided by the turnover. AP turnover is slightly different, a little bit more complicated, because we use purchases. Purchases divided by accounts payable. To calculate purchases, and just think about it intuitively first, we take the cost of goods sold, and in the case where inventory has increased, we add that to COGS. So, and in the case where inventory has decreased, we subtract it from COGS. So the idea is the company has an inventory balance at the beginning of the year. When it's using this inventory to fund its cost of goods sold. If it were to increase the inventory, then the purchases for the year would have to be obviously the amount necessary to increase the inventory, plus the amount necessary to fulfill COGS. And on the other hand, if the company was running off its inventory, it wouldn't need to buy as much. It would fulfill COGS from the inventory, and it would run down the inventory. And so we have to calculate purchases, but it's a little bit complicated and maybe even a little bit counterintuitive. But this is the way we do it. And once we have the purchases, we divide by the accounts payable. We take the accounts payable as, again, the ending balance off the balance sheet. That gives us the turnover. And if we wanted to go to days, remember days is just going to equal the 365 divided by the turnover, the accounts payable turnover. So let's think about adding these all together, putting them together. Sometimes companies will refer to a cash cycle, and the cash cycle consists of the AR days plus the inventory days minus the AP days. And think about this, the AR days are going to be all sales, because in our class we're assuming all sales are on credit. So it's going to be a big number, plus the inventory days, and then minus the AP days. And AP days, you can see, are a minus because AP is a form of borrowing. Accounts payable, a form of borrowing where we borrow from our suppliers. And by the way, we don't have to pay interest on it. So in a normal company, these numbers are big. This number is big. This number is pretty big, so I'll try to make it smaller. And this number is about, a decent sized minus, but the net of this is a positive. And so that tells us the amount of cash that's needed to finance the firm. And that also tells us a fundamental principle, which is that growing companies use cash. And that's fundamental. When companies stop growing, when they go in reverse, where sales go down, then their cash use, they actually generate cash. But normally growing companies, and in most of our modeling that we do here, again, because we're focusing on fundamentals, most of our modeling is on the assumption that sales are going to continue to grow for the most part. When we look at cash flow, and particularly when we look at what we call working capital, so we call this NWC, it's usually a use of cash, meaning we need cash. So next series of measures are the profitability measures. The most common one is the net profit margin, which is simply net income divided by sales. So that's a very fundamental ratio that's used by many, many people. The next one is return on assets. And that's simply net income divided by total assets. Again, we don't use average assets. If you're an accountant, or you have an accounting degree, or you work in accounting, or you're familiar with accounting, you may recognize that most accounting uses average assets. Here in finance, we don't, just to make it, it's a simplifying assumption. And we use total assets. We just use the balance as of the end of whatever year we're looking at. So in this case, net income, you can see from above, net income is 363, and then divided by total assets, which gives me the return on assets. And again, the 10.1 doesn't really tell us anything unless we know what the company's return on asset was, the company's return on asset was last year, or the year before, or the average over the most recent years, or what other companies in the industry do. It doesn't really tell us anything in and of itself, but it's a useful barometer. Return on equity is, we use net income divided by beginning equity. So in our class, this is a hot debate among finance experts. Some people feel you should use ending equity. Some people feel you should use average equity. But in my class, we use beginning equity. And the idea behind it, the intuition is, we have this lump of equity at the beginning of the year, and we're earning a return on it. And yeah, metaphysically, you could say, okay, after 30 days, we have more equity, so we have to earn a return on that incremental piece as well. That's a little too metaphysical. So we just have the simple-minded idea that we're starting off with some equity, and we're earning a return on it. And so that's why we use beginning equity. And it simplifies a number of calculations that will come later in the class. So that's why we do that. And in this case, again, the net income's the same at every step along the way. And the beginning equity in this case is just a number that I've created, basically. EBITDA margin is EBITDA, which is interest before interest, taxes, depreciation, and amortization, divided by sales. EBITDA is not a GAAP term. Sometimes we have to take the GAAP financial statements and do a little math to create EBITDA. Very few financial statements will have EBITDA as a caption. In our class, we don't use EBITDA margin too much, but we have to be aware of what EBITDA is. And so in this case, again, assuming that EBITDA was 967 divided by the sales. Sales have stayed the same, as you can see from my two examples that are fictional. And we get an EBITDA, fantastic EBITDA percentage of 41.8. Again, in and of itself, it doesn't mean anything. Facebook's EBITDA percentage is monumental. I think it's 85%. Whereas your typical, Emerson which is a wonderfully well-run manufacturing company, has an EBITDA percentage of probably, I'm guessing, 15, 20%. So very much you need to know what's typical for this kind of business, or even what's typical for the business itself in prior years. Going back to market value measurements, just to give you some basic definitions. Market capitalization, I told you you can look on Yahoo or Google. The way we calculate it is simply the price per share times the number of shares outstanding. And that gives you the market capitalization. The PE ratio, which we don't use too much in this class, but you'll use in some of your other classes, is the price per share divided by the earnings per share. Market to book is the market value per share divided by the book value per share. And the enterprise value ratio is calculating I'm sorry, this is not a ratio, this is how do we calculate enterprise value. We take the market capitalization plus the market value of interest-bearing debt minus cash gives us the enterprise value of the company. So let's talk about using financial ratios. As I think I've said now over and over, and you probably think I've become a great bore, ratios are not very helpful in and of themselves. They need to be compared to something. The most common thing is a trend analysis, which is used to see how a company's performance is changing through time. So we might do inventory turnover this year compared to last year, compared to the year before. Might do inventory days on the same basis, last year, this year, the year before. This year, last year, the year before. Same thing with receivables. Very common to look at days outstanding of receivables this year compared to last year, compared to the year before. And changes in that, frequently are studied very carefully. So very much it's a question of comparing it to something. And then frequently comparing it to companies in the same industry or in different industries for various reasons. But again, the ratios in and of themselves are not terribly helpful. Here we're going to turn to another topic called the DuPont identity. And we use the DuPont identity to calculate return on equity. Remember, return on equity is net income divided by equity, or profit after tax. I generally say NI. So if I say NI, it means net income. And I would say ROE is NI divided by equity. And the DuPont formula is this formula. It's the NI divided by sales, or profit after tax divided by sales. I probably should have changed this slide, but I copied it from somebody else, a professor of mine, and he liked profit after tax. But NI divided by sales times sales divided by assets times assets divided by equity. And if you notice here, if we write it out this way, NI divided by sales times sales divided by assets. By the way, you can't complain about my handwriting. Every student I've had in the past has complained about my handwriting, so I no longer take handwriting complaints. Equity. Okay, you notice that in every case, the denominator becomes the numerator. Denominator becomes the numerator. So sometimes I find it helpful to think about that when instead of having to remember this or write it down on my cheat sheet, once I start with NI over sales, I can just follow along and know the next one, sales, assets, and assets over equity. What do they represent? So what you can see right here is what they represent. NI over sales represents profit margin. We talked about that. Sales over assets represents asset utilization or asset efficiency. We really talked about that when we were talking about asset turnover. And leverage we've talked about, which is telling us how much of our company is financed with debt and how much with equity. So some people call this the three levers of value. It's a way that companies can think about improving ROE. Get this out of your way now. So you can read this a little better. So I think professors are fond of saying that you can improve your ROE by improving any one of these things. But the problem is these things are hard to change. Leverage is the easiest of all of them, but leverage, as we talked about before, realistically, most companies are not selling equity to reduce their leverage, so they have to reduce their leverage by greater profitability. So they're hard to do, but in theory, you can improve your ROE by increasing one of these things. So here's the DuPont formula written another way. Profit margin times total asset turnover times equity multiplier. And the equity multiplier, which is assets over equity, the equity multiplier is the name for that, is just 1 plus debt to equity. So in this case, we do use debt to equity. This is not debt to value. This is debt to equity. And an easy way to calculate it is to take the debt to equity ratio and add 1. That gives you the number. So we've talked about these already, about what they represent, but the big thing here is this formula. It's a very good, easy to use simplification that's worth remembering. Because you'll find on every exam there's some silly little question of just multiplying these things and you get ROE. Again, why do I do that? Because I want to have enough questions, and students get upset if there are not enough questions because then every question's too valuable. They miss one, they kills their score. So I have to throw in a lot of questions, and I don't want to have questions that take up a lot of time, so I have to have some easy ones. So you'll find some things just that simple. So here's an example. How do we do this? Here's the profit margin. And in this case, I gave you the equity multiplier, but remember, I could have given you D over E equals 0.39, and then I would get the equity multiplier by just 1.39. So here are the three things. What do? We multiply them. And when we multiply them, we get 14%. And it's really just that simple. So going back to ratios again, there's no way to know which ratio, there's no cookbook or recipe to know which ratios might be relevant in any given situation. Some of this is a little bit of art. Over a period of time, as you work in finance or work with financial people, you'll begin to know, in your company, you may just hear, in various meetings that one ratio is mentioned over and over again, or 2 or 3 are mentioned over and over again. And this will give you some insights into the ones that at least the finance department thinks are the most relevant in your company. Benchmarking is very difficult for diversified firms and conglomerates, and right at the moment there are more conglomerates than pure plays because the mix is different for every business. And the international, not just competition, but international operations can make the comparison more different because of differences in accounting and also differences in culture, differences in payment. Firms, of course, use varying accounting procedures and principles. Although they're all using GAAP, there's more latitude than you might think. And of course, firms have different years and different seasonal patterns. And then finally, there are extraordinary or one-time events. So let's go back to thinking about pro forma financial statements. Pro forma financial statements are frequently used to examine the effects of specific transactions or other changes in operations. And when we look at those, we basically go through a thought process where we say, okay, let's imagine that we bought this particular asset. What would it do to our income statement? Meaning, what would it generate in terms of sales or reduction in costs? And what would it do to our balance sheet? What would it do to our leverage? What would it do to our ROA? Variety of things. And we are doing this on what's called a pro forma basis, but you can think of it almost like we're imagining, okay, if we did this, what would it look like? So we do this to look at investments in assets, we look at leverage, we look at dividend policy, and we look at liquidity requirements. And all of those would be things that we would examine through a set of pro forma financial statements. Frequently, we start off with very simple assumptions, as I showed you before, just changing sales, keeping everything else the same. So it's really simple, meaning sales go up 10%, gross profit margin stays the same, SG&A percentage stays the same, and we roll this down and then we look at it and then we begin to modify it. You know, if we say sales grows at 10%, maybe SG&A only grows at 5%. Things like that, and we see what that would do to our financial statements. So this is what I just told you. We usually start with a sales assumption, and we use that, and we use that as our critical driving assumption to drive the analysis. And then after we get the basic analysis done, we usually start, some degree of varying of the other percentages. Then we create a base, and once we get that set, we usually call that the base case. And then we'll do some analysis from there. But calculating that base case is usually an important part of the analysis. When we look at financial planning, we think about the sales forecast, which I've been telling you about. We set up pro forma financial statements we're telling about. If we start with sales, we sometimes will think about what additional assets we need. So take a silly example. We think, okay, sales are going to, but a real example. Sales are going to increase 10% a year or 20% a year or some number. And then what we'll ask ourselves is, okay, can our factory produce that? Do we have enough machines? Is there enough unused capacity in our factory to produce that? And if we don't, what would we have to do to be able to produce the 10 or 20% increase in sales? I was recently in a meeting in a venture capital situation where I'm representing the venture capital company, and I'm doing due diligence, and I'm looking at the sales forecast. And the question that I asked was, can the factory produce this? This company it's a very interesting company. They make agricultural equipment. And we're down here in Kentucky, and agriculture is important. So they make agricultural equipment. They have some really nifty equipment. And there seems to be a great demand for their equipment. It has to do with irrigation. Seems to be a great deal of demand for their equipment. So the sales forecast looks pretty promising. And we've vetted it, so we feel that it's a realistic forecast over the next 3 years. And then I asked, can you produce in the factory? And that you have. Do you need, because if you need a bigger factory, then we have to work that into our capital requirements. I was pretty surprised to find out that the answer was no. They were amazingly honest. And they said, basically, if we could produce, 1 year, we'd be okay. And I forgot, maybe the sales forecast was 20% for the next year. They have a bottoms-up forecast. And so, meaning they went through very specific customers and came to a conclusion about how many customers would sign up and what the current customers would buy in additional products, et cetera. So I thought pretty well done. But apparently nobody had asked them about the factory. And so we then embarked on a long detour over how would you how would you achieve the second and third year forecast? And this just illustrates that here we are in the real world, and they were basically making the argument that they could outsource certain parts of the process. They wouldn't actually have to build a new factory. They would outsource certain parts of the process and be able to do the rest of the process, with the physical facilities they already had. They would need some additional warehouse facility, and they had one nearby that they were aware of that they could rent at pretty modest cost. So they didn't, it wasn't a case where they had a big expense looming in the future, but it was a case where we really had to examine the asset requirements, and I was kind of surprised that nobody had done that yet, but that's why you have due diligence. This is exactly what we were doing. We were trying to solve for how much money did they need. We had a certain amount that our company, the company I'm representing in this case, was going to put in, but they wanted to make sure that it was the amount that was needed to build the business. And then finally, a lot of times there's a plug, and the plug is almost always in debt. So as we look in our class, again, we're focused on fundamental principles rather than technicalities. A lot of times we're going to see that the left-hand side of the balance sheet is increasing. On the right-hand side, part of it is funded with accounts payable. In our particular case, for example, there was a bit of an equity infusion, but then there's a gap. And usually in our class, we don't have any equity infusion other than the infusion that comes from the increase in retained earnings. So then what's left over is a gap, and it's plugged by debt. So usually we're solving for the plug. But that's frequently the plug is debt. In the real world, that's a good assumption. When we're looking at financial planning, we frequently make assumptions about the economy. In my era, I hate to tell you this story because it shows how old I am. There was a period of time where inflation was rampant in America. You have to go back to your history books and see when that was. I'm not going to tell you. But there was a time, and we used to make, because of inflation was so high, we were simply increasing our prices every year. And as a result, we would sit down to do our financial planning, and we would make an explicit assumption that inflation was going to be 10%. And therefore, we would start off with a 10% increase in revenues. But of course, our costs went up 10% as well. But therefore, our profits went up 10%. Everything went up 10%. That was our economic foundational assumption before we started any additional planning at all. So, hopefully we're not heading for that world today, but obviously inflation is more of an issue today than it was in the last 10 years. Many of you are young people. If you're under, say, 30 years old, you've never lived in a period where inflation was meaningful as an adult. I mean, you weren't you were not paying any attention to inflation when you were a teenager, unless you were very strange. So as an adult, you've never had a period where inflation was negligible since the financial crisis through the Obama administration. And we're just now coming into a period where inflation is something to talk about. Of course, the Fed is trying to get inflation up to 2%. And then there's obviously a great deal of worry that it might be accelerating. So we'll have to see. Maybe by the time you hear this lecture, we'll have more insights than we do today in November 2018, where I'm recording. When we think about creating our pro formas, the percent of sales approach, which we've already talked about, is a useful approximation for many variables. We really look at the income statement by looking at the costs that are going to vary with sales. And that assumes, of course, that generally all costs we assume vary with sales. It's a simplifying assumption. So if sales go up 10%, all the costs go up 10%. That means the profit margin is constant at 10, whatever it was. Of course, depreciation and interest expense do not generally vary with sales. and therefore the profit margin would not be constant. Sometimes we make simplifying assumptions to say they do, just to make math a little bit easier for you. And dividends affect the balance sheet because they affect the amount of retained earnings. So that's an important assumption as we go forward. When we look at the balance sheet, we frequently assume that all assets vary directly with sales. Again, it's a simplifying assumption. Obviously, in the real world, fixed assets would not vary with sales. But just to simplify things, we assume that everything on the left-hand side varies with sales unless you're told otherwise. On the right-hand side, it's a little more complicated. We usually assume that payables vary directly with sales. However, we have to calculate retained earnings independently. What I mean by that is we look at income, we subtract dividends, and the excess goes into retained earnings. That will then create a plug that will be necessary because basically the right-hand side, you're going to have an increase in accounts payable, an increase in retained earnings. Frequently, that won't be enough to finance the increase in assets. So the plug is external financing. And we're going to talk about that in the next module. But that's the way we think about it. Again, it's a simplifying assumption to understand the fundamentals. So now we're going to delve a little more deeply into how much funding a company will need and how we calculate it. At low growth levels in the real world, internal financing, meaning retained earnings, is able to finance the entire business. And obviously, when we look at companies like Apple and Google, Facebook, we know that their internal financing is completely sufficient to finance their business. In fact, they have massive and growing cash amounts. But many other companies, it's a little closer. As the growth rate increases, in any company, the internal financing may not be enough. And then the firm will have to go to the capital markets, excuse me, to finance the growth. We're going to examine the relationship between growth and external financing, because it's really not just a useful tool, but a fundamental tool in financial planning. How do we decide, or what are the variables that will dictate how much funding is needed by a firm? Well, first of all, profit margin. And just by my examples, Google, Facebook have enormous profit margins, and therefore they really don't need external financing. And in most companies don't have those kind of margins, but that's one of the fundamental determinants of how much financing is needed. Total asset turnover is also fundamental. If assets are used very efficiently, that can affect the amount of financing that's needed. Financial leverage, and some of that is dictated, oftentimes professors will say financial leverage is a voluntary choice. But it's not, in the real world, it's not so voluntary, because the only way the reason professors think it's voluntary is that you can always just sell more equity. But in the real world, most people don't want to sell equity. And outside of the very largest companies, it's difficult to sell equity. So financial leverage is really, in a way, is related to profit margin. It's not so easy to change in the real world, but as professors, we assume it's a choice. I just, as a kind of non-professor, I would say it's not so much a choice. It's a little bit dictated by the market and the reality that most companies don't want to issue equity. Dividend policy is a choice, and it does have an impact on the amount of funding that's needed. The more you retain cash, the less you're going to need to go outside. So we have two basic financial ratios that we look at. It's important to know how to do these calculations, but it's also important to know the vocabulary. So the first is the internal growth rate, and that indicates how fast a firm can grow without any external financing. Hence the name, internal growth rate, gives you the idea that the firm is growing solely with internally generated funds. And how do we calculate it? Well, here are some assumptions, first of all, to do a little calculation. And we need to know the NI, the net income, the dividend, the number of assets, and we need to know the retention rate. And the retention rate, that's why it's underlined here, is 1 minus the dividend payout rate. And we abbreviate it with this initial B, just to reduce the amount of letters that have to be typed on a line. We need to know ROA, and in this case, we calculate B. We can see that the dividend is 22 in this case, and NI is 66. So the ratio is 22 divided by 66, and 1 minus the ratio gives us a dividend payout ratio of 2/3. A retention rate of 2/3. The dividend payout ratio is 1/3. So we're paying out 22 on 66, which is 1/3, and 1 minus that is the retention rate, and that's 2/3. So how do we calculate the internal growth rate? And this is why we needed all those calculations. We needed ROA times the return on assets times the retention rate. So the return on assets we calculated on the prior slide. Remember here, calculated ROA as 66 on 500. So ROA is NI divided by assets. So that gave us 13.2% of 0.132. And then we have it here, 0.132 times the retention rate, 0.667, divided by 1 minus ROA times the retention rate. And we get the internal growth rate is 9.65%. So what that is telling us is that the company can grow 9.65% without going to any outside capital. If it were to grow faster, then it would have to go to outside capital. Professors like to think that companies can control their growth rate. The reality is it's quite hard to grow slower. You can grow a little more slowly by raising prices, but this is a challenge for many companies, and small companies in particular hate the idea of limiting growth. So what's the next vocabulary is the sustainable growth rate. And the sustainable growth rate tells us how much the firm can grow by using internally generated funds and debt while maintaining a constant debt-to-equity ratio. And so the idea is that the intuition is it's basically profits plus debt, but without increasing leverage. So that's really the key thing to understand about the sustainable growth rate. And we're going to do some math in a moment, in the next slide actually. There are two ways to calculate. If you Google sustainable growth rate, you'll find two ways to calculate it. It was invented by a professor at the University of Washington. I just want to give credit to Professor Higgins, because many times I'll mention things that are created by professors at the University of Chicago. But this was created by a professor at the University of Washington. And he created this calculation that we're using in our class. And we use it because it's his creation. In fact, it's one of the books that I've assigned as optional reading. You have the Higgins book, and you'll see in that book, you'll see his argument why he's using beginning of the year equity. The other book that's optional reading uses end of the year equity, so they have a slightly different way to state the sustainable growth rate. So if you pick up the Ross book, and you're using that book as your optional reading. Of course, if you're not using either book, you don't have to worry about it. But if you happen to be using it, I want to tell you about it so you don't get confused and wonder what the heck is going on here. If you're the Higgins book, you're going to be fine because he talks about it in just this way. The Ross book does a different calculation, and I think it's too technical, and so therefore I go back to the Higgins way to do it. Happens to also be the way I learned it, and it happens that Higgins invented it. So Ross was a professor at MIT. He's no longer alive, but the book is today written by the chairman. The Ross book is actually written by Jordan. Dr. Jordan is a retired professor at Kentucky. And I've talked to Brad at some length about this. It's one of these arcane things that only professors can argue about. But I think it's a little too overly complicated. Again, because we're in a class learning fundamentals. So the sustainable growth rate is a very useful concept. It's simply ROE. We know how to calculate that. We can calculate it as NI over equity or DuPont. And a lot of times on exams, now we get the questions a little more complicated. We basically don't give you ROE. We force you to use the DuPont formula to calculate it. And then you might have to do a little math to calculate the retention rate. Remember, that's one minus the dividend payout rate. You know, make you do a little work to calculate the sustainable growth rate. But it's a very useful calculation because this tells us basically, and again, think about it intuitively, with our profits and with a little bit more debt, but with maintaining the same degree of leverage, we can grow at some rate. And you can see that the rate of growth is quite a bit higher, almost double the 9.65% of the internal growth rate. So it's basically the internal growth rate plus some debt. But not so much debt that it takes us to more leverage. So it's a useful calculation. And you know, we teach it and we look at it. I think the only caveat I would have for you is, I think in the real world, it's very difficult to figure out what to do about this. If your growth rate's faster, it's just reminding you that your leverage is probably going to have to increase. And, you know, but very few companies are going to, you know, kind of figure out a way to reduce sales. So this tells you that how do we use this? How do we calculate it? We usually calculate it, remember our balance sheet. We have assets and liabilities and shareholders' equity. And so assets are going to be a plus in this case, and that's the total amount that has to be financed. By the way, please make sure the assets go up if you have an exam question, because some goofy professor, I won't mention any names, but some goofy professor sometime will say, like, what's the EFN under these conditions? And what you'll find is that this is not a plus, it's a minus. And what's the EFN on that? 0. Stop. Don't do anything else. The answer is 0. You don't need to do anything. Don't spend any time on it. So just make sure that it is a plus. But if it is a plus, where are we going to get, how are we going to finance it? So I like to say, how are we going to finance it? How are we going to balance it? If you're an accountant, you say, it's got to balance. This went up. That's why it's a plus. So something over here has to go up. So accounts payable, we'll put a little plus. Retained earnings, we'll put a little plus. So then this gap is EFN, the external financing needed. And remember how to calculate retained earnings, because to answer the question of how much is EFN, you need to know what the retained earnings are. And that's how we calculate it. So let's take a look at, in this little problem, if we have the assumption on the prior slide, what are the additions to retained earnings in each year? So let me just go back to the prior slide What did I say? Oh, I'm sorry, I have the dividend rate right here. So the dividend rate is 25%. Year one, we have 75%. Year one, we have 585. It's going to be, and the retained earnings are 1 minus the dividend, which is going to be equal to 1 minus 25, which is going to be equal to 0.75 times 585, which is going to equal 438.75. And basically the same here, it's 650 times 0.75, which is going to equal 487.50. And 711 times 0.75, and that's always because we said the dividend rate's 0.75. So 711 times 0.75, which is going to give me 533.25. So these are the additions to retained earnings. It's just that simple. Usually there isn't a problem on exams that's this simple, but usually you need to know this. Why do you need to know it? Because you need to figure out this right here. You need to calculate the additions to retained earnings as part of this problem. Just remembering that's how to do it. It's 1 minus 0.25, that gives a 0.75, and then 0.75 times 585 gives you the additions to retained earnings. So just some caveats when we think about financial planning. Financial planning models are helpful, they're informative, but they don't really tell us qualitatively which financial policies are the best things to do. They are simplifications of reality, and the world can change in very unexpected ways. We will talk at great length in this class about something called the planning fallacy, which is a behavioral characteristic that we in finance took from psychology. And that is that many times finance professionals will develop beautiful models. Really beautiful models. Mine are very good. They're not beautiful because I'm not very good at like making them beautiful, making them look really pretty. But I'm good at making them complex. And I fall in this category, so I say this lovingly. You fall in love with your model. You think I've incorporated everything, and I've got like a base case, a best case, a worst case. I've even done some other things to it, and I've got this model. I've looked at sensitivity analysis, and I really feel like this is a reasonable model. And what happens when you look a year later? Boom, none of it came out that way at all. And I can remember that one of my colleagues, when I was CFO, and I was probably mentioned I was CFO of a global company, a $20 billion company. We had a very big operation in France, and the CFO of the French company was a really, really smart guy. I would say he was far better budgeting than I was. He was really, really sharp. And he would develop beautiful budgets. They looked beautiful, on paper. Plus, they were brilliantly thought out, brilliantly done. And every year we would sit down and we would look at the budget for the previous year. Of course, we're measuring as we went results against budget, results against prior year. And I would say of the 10 years I had the job, 8 years, he was completely out of whack on the budget. And the reason is the world changes. Things happen that we couldn't possibly anticipate. And we used to have very good, he had a good sense of humor, contrary to the stereotype of some people have of French executives. He had a very good sense of humor, and we would have like funny discussions about, oh, how can your budget be this far off? And he'd just laugh. And he would say, well, you know how it goes. You just can't anticipate some of these things. Something that a competitor does, something that a customer wants, more orders, less orders, wage increases, all sorts of things, strikes, also strikes at customers. Things happen that you just don't have any way of anticipating. So you always have to have that in mind, particularly as finance executives, that these are simplifications and they're models. So, I frequently used to say, let's not spend enormous amounts of time on the model because we know it's probably going to be wrong. Let's do a decent try at the model and we have a reasonable model, but then let's focus on running the company. And let's focus on navigating through the ups and downs of the tides and the waves as we go, and not get so tied up in our model that we can't think about anything else. And so here's my sea metaphor again. So looking at ratios, we've said this over and over, and I can't emphasize it enough. That's why I'm saying it over and over. Different industries have different ratios. And different firms have different ratios, and we're going to look at a few comparisons in a moment and see what it tells you. So here's a complicated slide. We have 5 companies here: Amazon, Ulta Beauty, which is a favorite company of mine, run by a genius, Mary Dillon, Target, that you probably know, Walmart, and Carrefour, you may not know. It's a French company. I put it on here because their financial metrics are unbelievably good. And if you look at their cycle, their inventory, so you look at their sales, their inventory days, and their AP days, and you see that the difference is very different for these companies. So let's see, Carrefour and Amazon have a negative number. Now, none of these companies have receivables because they're all selling for cash. They're all selling for credit cards. So that's why receivables aren't on here. So if you think about Amazon, again, I buy something on Amazon, which I do all the time, and I'm paying with my credit card. Amazon effectively has no receivables. But they do have inventory, and you notice that, look, their AP days are more than their inventory days. So who's financing their business? The suppliers. And how does Amazon get away with that? Well, because they have giant volume. And if you're going to sell Amazon something, their attitude is, well, we want 90 days to pay. That's accounts payable. And because we got 90 days to pay, and then that gives them cash to use, essentially, to finance their inventory. So, and then Ulta has much less bargaining power, even though it's about a $4 billion company. It's a much smaller company compared to Amazon. And Carrefour is interesting because it's not as big as Walmart, but it's probably well, let's look at the numbers, 76 euros, I have it right here. It's, not that far away from Target. Amazon now this is a couple of years old, Amazon now is quite a bit bigger. So I think Amazon now is closer to 200 billion. But Carrefour is quite comparable to Target, and you can see how much better Carrefour is at stretching their payables than Target is, because they have a 43 day advantage. In fact, Carrefour has financed their company for decades out of their suppliers. Same thing, they're a giant company like Target. On a French basis, they're the equivalent of Walmart. Smaller in absolute scale, but in France, the equivalent. And so they get very favorable terms. If we look at comparing those companies to some other companies here, here's BA is Boeing, CAT is Caterpillar, Facebook. This is a company called Ball. It's a manufacturing company, and then Apple, of course. But if you just look at Boeing and Caterpillar, 2 heavy manufacturers selling big equipment, and their inventory days are huge, and they can't get their AP days, all that high. And so they have a huge deficit that they have to finance. So that's why I wanted to show you and we do a few comparisons. Some final comments. Leverage ratios are frequently influenced by stock buybacks. We're living in a period today, and we have been for 10 years, but every year stock buybacks increase. When we get further into the course, I'll give you some data on the number of stock buybacks in 2018. But 2018 had a record of stock buybacks, and 2017 was a record, and 16 was a record. So as companies are buying back stock, their leverage ratios are going up. A good example is American Express. If you compare, you would think American Express would be roughly comparable, to Visa and MasterCard. But their leverage ratios are gigantically higher. Why? Because they've had much bigger stock buybacks, and they've financed it out of debt, and as a result, their leverage ratios look sky high. Current ratio, attitudes towards the current ratio have changed dramatically over the last decades. When I was your age, everybody thought you had to have a current ratio of 2 or better. Certainly had to be 1 or better. But today, companies like Amazon and Walmart, Carrefour have current ratios that are crazy. The liabilities are bigger than the assets. And today, people think that if you have a current ratio that's too high, it means you're actually inefficient. We used to think a current ratio was a sign of good liquidity, but now people think it's a sign of inefficiency. Some debt is certainly good. And that DTS is the debt tax shield, meaning the interest is deductible, dividends are not. So to some extent, having debt is a good thing. But how much debt should you have? Because if you have too much debt, it can raise the risk of bankruptcy. So we'll discuss that as we get into the class. We'll have a whole module on optimal capital structure. But as we think here about analyzing and evaluating companies, we see that some debt is good because tax deduction, too much debt's bad. There's a new generation of companies that are changing the world, the rules of the game. Facebook and Google are the obvious ones, have no debt and asset light. Takeaways to think about: common size financial statements are very useful for analytical purposes. Remember, that's turning the financial statements instead of numbers into percentages, percent of assets for the balance sheet and percent of sales for the income statement. Financial ratios are widely used by lenders and shareholders. The internal growth rate and sustainable growth rate are answers to useful questions about the amount of capital needed. And projections are simplifications of reality, but still useful for financial planning. And we test various assumptions, and we'll get into that a little more as we go through the class about how we do tests, which are called either sensitivity analysis or scenario analysis or other kinds of more complex tests. But we start off with a set of projections. I have an appendix here of problems which I was planning to do, but because of the length of the lecture, I think I will leave you to do these on your own. So this is a pretty simple problem of calculating ROE using the DuPont formula. It's just multiplying all 3 of these together. This is a question where you're asked to calculate the dividend amount paid. So you want to solve for how much of net income was paid out, how much of net income went into retained earnings. And when you do these problems, you look at the change in retained earnings as one component. So you're basically going to calculate net income minus the change in retained earnings, which gives you the amount of the dividend. So remember, retained earnings is equal to NI minus the dividend. In this case, we can calculate NI and we can calculate the change in in retained earnings. So we just have to solve for the dividend. And in this one, we're asked to calculate the amount of external financing needed. This is a little more, I wouldn't say complicated, but it's a little more complicated than preceding ones. And it's this is taken from an old exam that I gave, so this is good for you to look at, and perhaps we'll talk about it in class. And then this one is what's the retention ratio, and this is a pretty easy one to figure out because you're told what dividends are and you know what net income is. So you know that the amount retained is going to be equal to net income minus the dividends. And then all you have to do is figure out whatever that number is divided by net income. And that gives you the ratio. So that's it for me. Thank you very much for your attendance. Thank you for taking a look at this video. I think it'll be useful. Obviously, you have a chance to replay it over and over again if you want. You obviously will have the slides. They're posted on Canvas. They're already posted on Canvas. You also have the Harvard Business School list of ratios that they think are important in the Introduction to Corporate Finance class. Again, just to show you that we're all suffering here together. I had the same ratios at the University of Chicago. Again, I apologize. It's a bit of a numbers tumble, but I think in a way it's a good module to do by video. For those of you that are new to corporate finance, I'm worried about you feeling overwhelmed. This way you can go over it a few times. You have the Harvard list that's handy there. If you print it out, you can just check it compared to the ratios that I've given you. So you can have a couple of times. If you're new to corporate finance, the chapter in the Higgins book, which is listed on Canvas, is a good introduction to financial ratios. And while these look a little bit sterile, staring at them on a piece of paper, I know that. As we go through the class, we'll be coming back to them over and over again. And you'll see that they actually have a degree of usefulness. So thank you very much. I'll look forward to seeing you in class next week.